again. Welcome into Making Sense. Is it a good word? Is it a dirty word? Interest rates. It can either help you, it can hurt you. You know, you put some savings in the bank and you say, gee, what kind of an interest rate am I going to get? Nowadays, it's pretty low. But at the same time, go to borrow, and you're really looking, especially with a mortgage, at that low interest rate. But what can happen and what makes them go up? What makes them come down? We've got with us Brandt McDonald, Branco, Hagen Wealth Management. And the subject today, buddy, is interest rate. And, you know, we always keep hearing about, what's the Fed going to do?
Right. I know.
Like they're the magical people.
And
are they?
Well, yes, unfortunately they are, and it's not just Janet Yellen here in the United States. I mean, you've got Mario Draghi, and then you've got the Bank of Japan and the People's Bank of China. It's like, you know, any of these people, even the Board of Governors, you know, from Atlanta to Dallas, New York, wherever, here in the U.S., these are the Federal Reserve Board of Governors. They're always speaking too, and everyone's listening, and they have different opinions, and so the market reacts to all of this. It's really kind of a crazy day and age we live in when you know, you can have the greatest investment thesis in the world, and then any of these central bankers can blow it up in a 30-minute speech. So, yes. And so, you know, a lot of our clients ask us every day, you know, about interest rates, particularly when you start talking about the concept of balance sheet management. Things like, obviously, a mortgage interest, you know, the rate you're paying on your mortgage, or credit cards, or business loans, lines of credit. All of these things are so critical. And, you know, by the time we're taping the show here today, and by the time we air it, who knows what the Federal Reserve will have decided to do in September. But I would tell you, in my opinion, there's absolutely no way they can raise rates.
We're going to have a good way to tell this, because this is August 25th, right?
Right.
And today we're taping. We'll see. You're a good predictor, though. You're going to be good. This is going to air the last week in September.
This year we've been pretty spot on.
I know you are.
Thank the Lord. But no, you know, I have very close contacts in New York as well as Washington. I don't want to get too complex here, but let me just say this. You know, the Federal Reserve really missed their window of opportunity. They've been sitting on what the industry has referred to now as ZIRP, Z-I-R-P, zero interest rate policy. And they've been sitting on ZIRP way too long. Many months ago, they should have moved off zero and begun to normalize interest rates. You know, when you have GDP growth rate of around 2%, you don't need to be at zero. That's way too loose monetary policy. And it's creating a lot of unintended consequences, you know, encouraging improper risk-taking, not just at the retail level or individual level, but at the institutional level as well. And so rate normalization is critical. Now we've seen all this market volatility and a tremendous slowdown in China. I just don't, these are too great of headwinds for the Fed to, you know, stare that down and raise interest rates in spite of it. They've missed the window of opportunity in my view. So I'm thinking the closest we're going to see a rate hike is going to be next year in 2016 at some point. So let's talk about what people can do. I think that in this type of environment, you've still got an opportunity to get in there and really manage your balance sheet the proper way. Credit card debt, remember that if rates do go up at some point, you can start to see your interest rate go up pretty quickly. Lines of credit, the same type thing. And certainly with the potential to refinance a mortgage or to purchase a home, you know, now's the time to do it. I mean, this is a historical time where you've got 30-year money,
low,
unbelievably low interest rates. I think that if you know for sure that you're not going to be in a home for 10 years or more, you want to question whether or not maybe to buy, because you're essentially renting money at that point. So your cash flows to service the debt are going to be a lot less than rent, but then you also own the responsibility of maintenance and upkeep of the home.
That's right.
So you want to look at, do an analysis on that. If it's a newer home, it may be worth it. If it's an older home, make sure that you've done an analysis on, you know, things like the air conditioning units and water heaters, the roof and all of those things, because by the time you get to the other side of it, if you've had to replace a lot of that stuff, you may have spun your wheels and you've just been well off renting, you know. But if you're someone who really wants to dig in and own a home for a while, now's the time to do it, particularly if you can get one at a pretty good price. I think, with respect to interest rates and how to manage your fixed income portion of your investment portfolio, Absolutely. You want to be very, very cautious with that, extremely cautious. I think that, I look at some clients who come to see us for the first time and we do a review of their portfolio, and the fixed income holdings they have are staring right into the teeth of a massive bear market that could potentially happen when and if the Fed does start to normalize interest rates. So you want to be what I would call very tactical and very sort of proactive in managing that part of the portfolio. One of the things we do at our firm is we have two advisors who I consider to be really experts in this area and do an incredible amount of research on the fixed income side of things. And so every week when we sit down, we're always talking about, the fixed income market. And you have to, because it's 2/3 of the overall financial market. Equities or stocks are only 1/3. So the bond market is a huge, huge market. It's one that most people don't pay attention to.
Right.
But the bottom line is rates are probably going to stay the same. You have a window still open to get things right.
Good. We appreciate that. We appreciate you being with us over the past 4 weeks. Some great insight. And just remember this, if you need some information, it's called McDonald, Barranco, Hagen Wealth Management. They'll give you a free evaluation.
Yes.
Come on in, there's no obligation, but you can have somebody that's interest is only you, not any company per se. And we'll be right back right after this.